Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett, and Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and also a qualified intermediary for tax-deferred exchanges. And Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996, only yesterday.
Only 20 years ago, yeah.
And set up his own law firm. And anyway, he's past president for the East Bay chapter of California Society of CPAs. He does continuing education for CPAs in the area of real estate and exchanges. And in a past life, a little more fun, he was a sports writer, and he covered Major League Baseball, National Football League, and other sports. Thanks for joining me today, Scott.
Hey, thanks a lot. I appreciate it.
Okay.
Good to be here.
So today, Scott and I are going to be talking about tax-deferred 1031 exchanges of real estate. I'm going to mention the date because things are a little problematic out there. It's May 23rd, 2017. Things may change in the not-too-distant future. And I will also say, if you get involved in looking at doing a 1031 exchange, we want you to get good professional advice. So see your CPA, see your tax attorney, and get a good intermediary involved. Okay, off we go, Scott. Are people doing tax-deferred exchanges in real estate right now?
So it's a good chance to step back and explain what it really is.
Yeah.
So there's a situation where when somebody wants to sell a piece of investment real estate,
Okay.
or it could be non-real estate, but we deal mostly with real estate in our practice. This could be a commercial building, a 4-unit building, could be a single-family home that's rented to a third party, leased, those types of things, investment real estate. When they sell, if it's appreciated in value, or if you've had it for a long time and if you've depreciated it on your tax return, you're going to face a taxable gain if you just sell it and get the money, get the proceeds.
Right.
So the strategy is that rather than to sell the property, is to line up the purchase or acquisition, if you will, of the replacement property, said to be of a like kind. And like kind, of course, for real estate is very broad. So an exchange, in the old days it used to be I give you something and you give me something in exchange. And under current practice, and it's been this way for many, many years, 35 or so years, an exchange is really a sale on the one hand, and at a later point, typically at a later point within 180 days, a purchase of a replacement property. And that's not to say that those events are completely independent, but that you have to do certain things document-wise to make sure that you tie them together to call it an exchange for tax purposes. So are people doing them? Yes. It's our business is as robust as it's ever been. We handle exchanges. I've got a staff person who does nothing but exchanges, and we do all the documentation, and we consult with clients all the time on exchanges, whether they should do them, or in what way, and what the strategies are, and so forth and so on. So it's very, very robust at this point.
Good. Okay. So you mentioned for real estate that it's broad. Maybe you can talk about, for real estate, what is like kind?
And so there's a sort of an urban legend out there. To digress a little bit, it's always gives me a chuckle when somebody calls and says, "Well, I was reading on the internet ... about so forth." So all I can say is that might be a good starting point to get some basic information, but I would take everything you read on the internet with a grain of salt, because not every statement applies to every situation, and some people flat out just get it wrong, even though they seem to be publishing authoritatively. So, so the question about real estate and like kind, the statute, the 1031, is a code section in the Internal Revenue Code, and it says that the properties exchanged have to be of a like kind, and it's been determined through regulations and so forth and other advisory that like kind for real estate is very broad. So it's possible. Some people call me up and they'll say, well, I have a 4-unit building, but I don't really want to buy a multifamily property. I really want to get into a commercial property. I said, that's okay. That's like kind. Even though it may not seem like kind, for this purpose, it is of a like kind. So you can do raw land for improved property. You can do commercial for residential. You can do residential for residential, single family for multifamily, and so on and so on. And so that's very, very broad.
Okay. Okay. So some people call these tax-free exchanges.
Yeah.
Can you ever have taxable income come out of one of these?
Absolutely. And actually, the statute calls it a tax-free exchange. When you look in the major header of the subchapter O is what it's
Okay.
called. The code says gain is not recognized. Recognition of gain is when you sell something or even when you exchange something, except for these special provisions, and 1031 is one of them. Now, it's possible that when you do an exchange, you do partially exchange of a like kind, and then partially what's called other property, or sometimes called boot. So let me give you an example. So you own a property that we agree is worth 100, and I own a property that we agree is worth 80, and we want to do a trade, and we do trade, but you say, wait a minute, my property's worth 100, what are you going to do for me? And I'll say, well, I'll throw in $20 in cash to make up the difference. So it is a valid exchange. So for the guy giving up the 80, he doesn't have any taxable income, but the guy getting the 20, which is you in that example, you're getting other property in addition to the like-kind property, and that's said to be boot, which can trigger a taxable gain, notwithstanding the fact that you do get some tax deferral as well, so you get a little bit of a mixed bag.
Right. And what a lot of people don't understand is they may not see any cash at all come out, and they can still have a taxable gain.
That's correct. So let's just use a sort of an extreme example. Let's say that a long time ago I bought a property for 100, and it's all been fully depreciated. Now I've had it for so long, it's fully depreciated, and there was no land component. It was just fully depreciated. And let's say that over the years it's gone up in value, and every time it goes up in value, my mortgage consultant calls me and says, "Boy, you got to refi and take out." So the property appreciates, let's say, up to $1 million, and the loan balance is $999,000 or something like that. So I sell it, and I get $1,000. And I'm thinking, wow, okay, so I got to pay tax on 1,000. Well, that's not how it works. How it works is all that money that you took out was like money received today, even though you got it a long time ago. So it's possible for someone to absolutely be clobbered on a gain on a sale and not have any cash to show for it. And that's the sort of the naive plea is, how could I have tax? I don't have any money. Well, you got that money a long time ago. So therein lies the first advisory about get good advice. Talk to your preparer about any sort of significant transaction.
Right. So if someone brought it to you or to me, basically what we would try to do is pro forma out what the figures look like related to this exchange, in particular looking at the liabilities related to the property that we're acquiring, property giving up, and so forth.
Correct. So in that example, let's say that that sale does go through and there's this $1,000 left over, and that's put towards the purchase of another property for $1 million or more. Well, that's okay. The question is, how are you going to pay the difference? Is it going to be a new loan, which is okay? That can be tax-free. That can be a non-recognition transaction. Now, if you don't do that, though, and this is what I get all the time. So people call up and they say, well, if I don't do an exchange, I'm thinking about doing an exchange, and I'm going to sell this today, and I'm going to have 45 days to identify, and I'm going to have 180 days to replace, and those are statutory things we're going to talk about in a few minutes. What happens if I don't get the replacement property? I don't finish the exchange. So I said, well, you have a taxable event over here. So the best advisory at that point is, if you have a taxable event, is go back and do a tax projection on your individual tax return or whatever return you're dealing with, because you got to figure there's going to be some tax at some point. So.
Right. And too often people sort of show up after the fact.
Yes, correct. Correct.
Oh yeah, I forgot to. I really probably should have called you about this.
Right. So this is May for tax preparers. For tax preparers, this is extension season, and there will be some clients who are maybe got an extension and they're coming around. They always come around in the summer to do their taxes, and then they'll say, "Oh yeah, well, boy, I just thought you could fix it because they did it last January or something along those lines. They did some sort of transaction. We can't fix it after the fact. That's just a report."
Yeah.
So.
Yeah. Okay. So people might have heard these terms. What's a deferred exchange and what is a simultaneous exchange?
Yeah, so simultaneous exchange is best illustrated with an example. So let's say I have a business truck and I run it into the ground. It's a 5-year-old truck, but it's got 1 million miles on it. And then I take it down to the dealer and I say, my truck is worn out. Can you give me a new truck? And they say, sure. And they give me $1,000 credit for my old worn out truck and I get a new one right out of the lot. Well, that's a trade-in. That's a common thing. That if those are business properties, they're not necessarily real estate, but if they're business assets, that's a like-kind exchange because I'm giving up property and I'm getting property in return. So that's a simultaneous exchange. That's one of the most common things. It used to be that ranchers, and how this sort of got started 100 years ago in the statutes, ranchers would say you'd have a plot of land that you didn't really want and I wanted, and vice versa, and so we would do a trade, maybe water rights, maybe some other sort of real estate interest, and those trades would happen simultaneously. And the reason why the statute came into place is because we'd have a trade, and except for this provision, we'd have a taxable event, but we have no money. Because all I got in return was land or something that's not liquid. So the statute was created to sort of help us there. So those are two common types of simultaneous exchange. Now the most common thing today, after the Starker case that came down in the 70s, is the non-simultaneous exchange. So that's morphed into a truly typically, although it can have a lot of different permutations, but typically you'll have a sale, which is a completely independent event from a purchase at a later date. That's what they call deferred exchange. Deferred meaning deferred in time. So I might sell something today, and then I might buy something within 180 days of today, and that would be considered an exchange, provided that you engage the services of the intermediary, sometimes called the exchange accommodator.
Yeah. So maybe we can get a little more into the mechanics. So again, what are the requirements? I think you sort of alluded to it before for identifying a replacement property.
Right. So let's say today, for example, is May 23rd. 45 days from today would be July 6th, I believe. Don't quote me on that, but you can do the math. So on or before the 45th day, after the closing of the sale of the relinquished property, the taxpayer must, in writing, basically send a letter postmarked on that 45th day to the qualified intermediary, or possibly the title company, but usually the qualified intermediary, and simply say, I'm, in respect of the sale that occurred on May 23rd, I'm identifying Blackacre, which is a parcel of real estate, as my potential replacement property for the sale that occurred on May 23rd.
Right.
And it's simply a private communication. It's not an offer, not an LOI, not anything along those lines, just a private communication.
Okay. And when does this whole thing have to be finished?
So it's 180 days. So for May 23rd, if this were the closing date, it would be roughly November 20th, plus or minus.
Right.
It's not 6 months. I get that all the time. Oh, so 6 months. No, it's not 6 months. It's 180 days.
Right. And now, related to this, we can say it's the earlier of the 180 days or the tax return due date.
That's correct.
And so if you have one of these, you're probably going to want to extend the due date for your tax
Right.
return.
So that gets into a misnomer. So if somebody's on extension right now and they're starting an exchange in 2017, that's not what they're talking about.
Mm-hmm.
So let's illustrate that point. For a calendar year taxpayer, for an individual, the deadline is, it's not April 15th anymore because we have the federal holiday, but it's April 18th, I think, or 17th. There's some day. So the statute says that the 180-day time frame is cut off, is truncated, if the due date of the return for the exchange in question occurs before that date. So the practical limitation is when your exchange starts on or after October 15th in a calendar year, then you will not get the full 180 days unless you get an extension. So that's that last 2.5 months of the year that you have to consider getting an extension. And hopefully your tax preparer will alert you to that. And usually they can't even finish your tax return if you haven't bought the property, because that's when
Right.
it's reported anyway.
Right. As long as you told your tax return preparer that this was going on, right?
We've seen a couple of cases down through the decades of a slip up, shall we say.
Yeah. So these, in other words, these are sensitive transactions, and it's easy to have these things blow up in your face, and when you do, it can be a very expensive mistake.
Correct.
So that's why, again, we're saying you really need to have professional guidance all the way along the way, and let people know what the heck is going on.
It's not a do-it-yourself deal. And frankly, you can't. I mean, the regulations have laid out a safe harbor. If you try to do it yourself or have your dad do it or something like that, or, I mean, it's just it will blow up. There's no question. We've tried to see that.
So an important person in this whole scheme now is this thing, the qualified intermediary. So
Correct.
maybe you can, and you happen to be one of those.
Imagine
So,
that. Yeah.
so maybe you can explain a little bit about the role of that. person.
So here's the concept. This is sometimes called a legal fiction, this whole thing.
Yeah.
So the reality is, I've got White Acre and I'm selling White Acre, and I'm selling it, and there's some buyer's going to buy it, and that's just a real estate deal. And over here later, I'm going to buy Black Acre as my replacement property, and that's its own deal. The only thing that ties these things together is a practical matter. Usually there's some proceeds. So I sell this property and I get $1 million net proceeds after I pay off my loan and my commissions and my transfer tax and all that. The $1 million goes over here as the down payment. And then there might be loans or other monies put into that closing, but that's the flow of funds. Now, for tax purposes, if in this example here I got the $1 million and I get paid the $1 million and I'm the taxpayer, I have an immediate taxable event with respect to that transaction. So the regulations related to 1031 have created this fiction that if the so-called qualified intermediary is designated to obtain those proceeds from closing and hold those proceeds with the strict instructions not to do anything with them until placement over here as a down payment, then the funds are said to be set aside or beyond the taxpayer's actual receipt or constructive receipt. So qualified intermediary is not a related person. It's typically somebody in the business of being a qualified intermediary. And there's a whole bunch of other protocols that are set forth in the regulations that instruct us all, including the qualified intermediary, how to conduct themselves during this process.
Okay. Is there any risk when you choose an intermediary?
Absolutely a risk.
Darn.
Yeah. So just choose me. There's no risk with me, right? So the intermediary, and this is now in the early days, and back in the 80s and 90s and so forth, it was a lot worse. Now there's a lot more sort of regulatory control. So in California, there's a rule that says that the money. So let's remember what's happening here. So the title company, the closing company, is taking the money that belongs to the taxpayer and giving it to me. You just met me. You just got to Michael sent you to me because he knows I'm an intermediary, or your accountant did, or somebody's. But you don't know me except for this referral from Michael or somebody. And so I get your money. I'm holding your money. It's a corporation and so forth and so on. Well, what we have done in accordance with the rules is there's two ways around this. One, I can buy a bond, a fidelity bond. Very expensive. We don't do that, but that is it's an available avenue. The other thing that we do is we actually set up a segregated bank account, and we put the money in the segregated bank account, and the name of the account is our company name with the taxpayer's name, so it's very clear whose money it is. It's a trust arrangement, basically.
Yes.
And the bank is in on this, and they will require both parties, both the taxpayer and our company, to sign any disbursement. So I can't unilaterally go into the bank and just send money to the Caymans or whatever the case may be. So that safeguard was adopted. We've had that for years in our company, but that safeguard was codified in 2009 as a result of some of the big title company went out of business and money was lost. It wasn't theft in a criminal sense, but it was just a bad business. But there have been a number of bad actors stealing intermediary funds and so forth and so on. So those safeguards are in place. But yeah, it pays to know who you're dealing with. No question. No question.
Okay. So what would happen if the intermediary defaulted?
So I think in this environment, the most likely
Probably.
thing is the bank defaulting.
Okay.
Okay, so you pick Bank X, and Bank X goes out of business, and they can't deliver the funds. So it's a very short time frame, but that would be the most likely thing.
Okay.
So there's a rule that was adopted, and the number escapes me. I think it's 2010-14. Is that right? There was a revenue procedure. There was a revenue procedure that basically told you how to report your default. And it becomes basically a glorified installment sale. You're not finishing your exchange, but you never got your money. And so the gain is deferred until either the funds are recovered or once and for all the source of the problem is declared irreconcilable or irreparable. And then you'll have possibly a taxable gain and possibly not. And there's ways around it.
Okay. Let's see here. Can you use an exchange to combine the proceeds with a property that you already own, like to pay down debt?
So that's a great question. People ask that all the time. So I'd like to sell Blackacre, and I'm going to get $1 million proceeds, and I own a commercial building, and it's got $1 million loan on it. So I want to exchange and pay off my loan. That's not considered receipt of property. That's considered application of the money. So it's not really an exchange in a sense. So that just doesn't work.
Okay, well, what if you have a vacation home or a residence, like, I guess we sort of have a two-part question. So, if you have a vacation home and you rent it part-time and you use it part-time, that's one scenario. The other is some people wonder whether they can actually exchange their residence or exchange into a residence. So
right.
maybe you can sort of get those.
So remember, the statute says that a property that qualifies for this special treatment, both the relinquished property and the replacement property, have to be property of a like kind, and they also have to be held for business or investment. So there's been a great number of court cases and so forth trying to decide whether a vacation home is considered an investment property. A lot of people say, well, it's true that I went there every weekend to go to the beach, but the only reason I bought the property because I expected it to go up in value, and so that all that personal use was incidental. Well, that's nonsense, okay? So in response to that, in 2008, the IRS issued some guidelines. They created a safe harbor, and they say, look, if you have what's so-called vacation residence, and you only use it a de minimis time, 14 days in a fiscal year period, and you do that 2 fiscal years in a row, then that property could qualify as a 1031 exchange. So they've set that forth. Now, if you fall outside of that, then you have to look at facts and circumstances, and then you might have a little more difficult struggle on your hands. But something purely personal, and you're saying, oh, it's business or investment because it's going up, there's some court cases on that really knock that out of the box. So the takeaway is, let's talk about what you got going before you start selling things, because once you get into escrow and you're selling and you're buying stuff, then it may not work. So you may want to change your behavior or conduct.
Okay. And what about the thing about trying to exchange from, let's say, an investment property into a personal residence?
So the IRS has said that a property held in a certain character for 2 years is considered investment property. So I buy a property, I rent it out for 2 years. After that time, I change it. I move into it as my principal home. So that's okay. You can then all the tax that's avoided, the deferred gain, that carries over, and the fact that I move in doesn't trigger any sort of tax. There have been cases where this so-called 2-year rule that the IRS comes up with has been shortened. The courts have allowed for shorter periods and so forth. So if you're considering doing something like that, which is a strategy, you really need to get some serious advice about that, because not every situation is exactly the same, and there's sometimes it's a disaster and sometimes it could be okay.
So we only have 3 minutes left. I'm almost afraid to throw this out, but can you, you mentioned to me that there's this new Bartell decision.
Right. So
Can you
two points on that. The Bartell case came out last August. So the aside is they briefed the case in 2007, and the court didn't issue its decision until 2016. It's
Wow.
amazing. It took 9
Wow,
years.
9 years.
United States Tax Court. Okay, so let's just take a real quick step back and say you can do exchanges in reverse order. So I can buy a property today and call it my replacement property, and I can sell my relinquished property at a later date. And the IRS has said that if you sell within 180 days of the date of purchase in reverse order, then that's a safe harbor, and they will accept that as an exchange. So the Bartell case was actually occurred before that safe harbor arrangement was issued. And the Bartell case holds now, if you follow the same protocols, you conduct yourself exactly the same, you can buy a property today as a potential replacement property, and you can hold that property with me, with the intermediary, sort of in nominal form, and you can treat that as a replacement property up to 2 years later. So the takeaway on that is anybody's in sort of the property wheeler dealer game. The problem is people come up to me all the time and they say they'd love to buy my property, and I say I can't do a 1031, I can't find anything. But if you've bought something a year ago and you're just sitting on the shelf and you say, oh, I can sell this now because I'll just go back and reach and back and exchange for what I bought last year, and it'll work out just fine. So that's the Bartell case, and you're right, we have run out of time.
Yeah, so you have to, though, plan that well in advance.
Correct.
That's the key.
I think the key is when you want to buy investment property, if it's not an exchange, you got to think Bartell, and that's really the key, and
Okay.
that's what we're counseling people.
Okay. We're really just about out of time. Maybe you can just throw out a final thought related to 1031.
Boy, don't close. Don't close and then call up and say we want to do our exchange now. That's the thing that happens all the time. I closed last Thursday, but I haven't cashed the check yet. Now I want to do my exchange. Well, it's too late. You got the money. You have, oh, we didn't cash the check. Yeah, but you have the right to cash the check, and that's the problem. So don't close any real estate transaction without talking to somebody. Even 24 hours, it's not too late.
Okay, so you can put one of these together at the last minute.
Correct.
Scott, I want to thank you so much for joining me today. Okay, folks, get professional help. See you next time on Financial Insider Weekly.